Is this ETF still beating JEPQ, QQQI, and MSTY? What about ULTY? Well, if we look at this chart, Netflix done pretty well at close to 30%. Now, if we look at some of the numbers, if you had invested in Netflix last year, you'd be up 60% compared to QQI's 19% and JEPQ's 12.5%. Now, Netflix is doing pretty well, but how is it doing against other funds? Stay tuned. Okay, so in this video, I'll briefly talk about Netflix numbers, see how it's been doing this past year. We'll talk a little bit about the Netflix context and the upcoming earnings. So let's start with the Netflix numbers. Now, if you don't know what Netflix is, it is a yield max product and it does Netflix option strategies. And these option strategies are synthetic options. And the goal is somewhere between 30 to 40% distribution. Now, I know what you're thinking. It's another yield max product, so there's probably some NAV erosion. But when we look at the price history when compared to the S&P 500, Netflix done pretty well, and I think its NAV erosion is actually under control. And if we look at the payout history over the last 12 months, it's averaged about 53% or 65 cents. Now, for me, my goal, at least in my portfolio, is to have a payout over 30%. So if it pays 40 cents or more, that's a win for me. So let's see how it does against other ETFs. Well, if we look at MSTY and ULTY, not bad. MSTY has done pretty well the last few weeks. I know some people have been disappointed with some of the payouts, but total return, if you had purchased this at the beginning of the year, you'd be pretty good. Now, if you look at the maximum drawdown, this is probably not a surprise, but only negative 4.5% compared to MSTY and ULTY's, almost double digits in the negative, and an S&P 500 close to 7.5%. Now, if we look at some BDCs, I chose some really popular ones, Main and ARCC. And if you had invested earlier in this year, again, Netflix, you'd be up close to 30% in return. But look at Main, almost 5% in ARC, same thing, right? So these have done quite well. And for me, I think they really make sense if you're, in the wealth accumulation phase. And you might be thinking, oh, but BDCs, they probably have a lower yield, so they should be safer. But if we look at Netflix's maximum drawdown, that doesn't seem to be the case. Now, if we look at some other yield max products, I've had YMAX and YMAG in the past, and they do serve a certain purpose. They do take a hitting anytime there's some um, news announcements or something to do, with macroeconomics. But generally, a lot of people have them, so I chose to see how they're doing against Netflix. And the return for YMAX is positive, which is good. And YMAG, anything related to the Mag 7 is pretty volatile. So it has been taking a beating this year, and it's down negative 5.78%. Now, if you look at the maximum drawdown, this is to be expected with YMAX and YMAG. But I think some people, they look at the distribution and it's higher than the negative or the NAV erosion. So it sort of makes sense in the long run. And total return is probably higher. Okay, how about some index funds? I chose some popular ones from Roundhill, QDTE, and XDTE. Wow, look at this return. This shouldn't be a surprise. Index funds generally don't return as much as single stock covered call ETFs. They're usually safer, okay? But according to this one, Netflix is still safer than both Roundhill funds. And finally, some recently popular ETFs. I mean, QQQI has won like the best active ETF award. But if we look at the return, 30% compared to 5%, that's a big difference. Okay. Again, these funds, I'm not saying which one's good or bad. I think they fit in everyone's portfolio. You just have to know, what phase of an investor are you? Are you in the wealth accumulation phase or the wealth preservation phase? And I think for me, QQQI and SPYI are more targeted for people who are in the wealth preservation phase. If we look at the maximum drawdown, again, Netflix has done pretty well against these two. Okay, so I'll talk briefly about the Netflix context, and I think understanding Netflix will help us understand Netflix. So looking at the basics from Q1 earnings, double-digit revenue growth, 13% increase year over year, so that's fantastic. Future growth, they do have ad-supported tiers, pricing power, and they're trying to expand in live action markets and gaming. So think sports, think wrestling. Okay. And if we look at this chart, wow, I mean, 92% over the past year, that's great. But that's also some concern for some investors. And we'll talk about that in future slides. Now, if we look at TipRank's average price target, they forecast a high of 1.6K, an average of 1.3K, and a low of just a little bit under $1,000. Okay, so here are some concerns. PE of 58.9 is considered expensive, and I think even the forward PE is about 40 something, so it's still quite expensive. And so some people think, ooh, this might be a bubble. And if we look at the beta, anything over 1 is pretty volatile. Okay. Now, if we look at future concerns, there is a saturated market, and some analysts talk about the evolving competition. Think Disney, think YouTube, think Hulu, think any other platform that has a streaming service. Now, Netflix does say they have a lot of initiatives to monetize certain things, but we still want to see if that's actually going to happen. Okay, so I'll briefly talk about the Netflix earnings and give you some final thoughts. So, looking at the last 4 earnings, Netflix has beat, and it has beat with a surprise. If you look at the numbers, they're pretty good. And even the 4 earnings before this, they did pretty well. Now, if we look at revenue, again, I said this in the previous slide, they beat. So the last 4 earnings, they also beat. That's pretty good. And if we look at a summary of the Q1 earnings and we zoom into the last 3 lines, let me zoom in a little bit more. Something to look forward to in the second and third earnings call is to see, okay, are they actually doubling ad revenue? I think some investors will be paying attention to that. Also, they'll be looking at seeing how much free cash flow they'll have by the end of the year. In Q1 earnings, they aim for 8 billion. How close will they get to that target? We don't know, but I think investors will want to see some progress. And we do have AI disruption all over the place. So I think some investors are also looking to see how they're going to capitalize on AI. Okay, so I showed you this chart earlier, and you can see that as we're heading into July, there's a little dip from Netflix. And so let me show you how Netflix and Netflix move together in price. Now, when Netflix goes up, Netflix does participate in some price appreciation, but like a lot of yield max funds, it's capped, right? So it'll participate in some of the rise, but not all of it. However, when Netflix goes down, Netflix will participate 100% in the downside. So if Netflix does well, then if Netflix does well, Netflix should stay relatively flat or just a little bit higher. But if it does poorly, then you can see probably a decline. Hopefully not a sharp decline. We'll see, sometimes these earnings, they're good, but for some reason the stock is down, or the earnings are bad and the stock is up, right? Now, I recently saw or heard a podcast on Seeking Alpha with Dan Rayburn, who is supposed to be a media specialist. And he says that Netflix is still the gold standard, and there's a lot of problem with how people are measuring other platforms. And so he says that there's a problem with the Nielsen metrics. Okay. And one thing he says is, large viewership is not a sufficient metric to determine the health and profitability of a business. And he goes on to talk about YouTube, saying he doesn't know the number of paying numbers because it's not actually published. I think he said something where they talked about the profitability of ads, but not the profitability of its paying members. And so we don't know the margins on some of these businesses. So for me, after the podcast and doing some research, I don't know, in the interim, I think it's not an either or situation. I have both. I don't see giving up any one of them. Would I pay for YouTube? Maybe not yet. I think there's just so many other ways to get content these days. And some of the free stuff I'm pretty satisfied with. But if they ask me to pay, I don't know. I have to make that decision when I come to it. But right now, I don't think you have to choose. You can have both. And for the second part, with the AI disruption, Netflix is such a big company, and they have a lot of money. So I'm sure they're going to figure it out. We'll see. I don't know. I can't tell the future, but that's just my guess. Okay, so that was just a little quick check in for Netflix and Chill episode number 2. I chose to release this episode now because earnings are coming up next week and Netflix's distribution is going to come the week after. So this may be some good data points for other people. Again, I'm not trying to persuade you to buy Netflix, but I like to do research and I like to share it with the community. So I hope I added value today. Thank you very much for watching, and I'll see you in the next video. Take care.